Nick Sherry, formerly Australia's first superannuation minister, chair of the Senate Committee on Superannuation when compulsion was introduced back in 1992. 25 years experience both in the political policy but also as a trustee prior to politics in our superannuation system. Australia is moving towards a higher level of compulsory contribution. It's currently 9 going to 12. Now logically, if you're moving to a higher compulsory contribution, what is then the rationale for having high levels of incentives to contribute over and above what will be a 12% contribution? Logically, the current level of incentives, and the major one is the concessional tax treatment. It's tax-free obviously at age 60, tax-free, but a 15% contributions tax and a 15% earnings tax. Logically, government will reduce the incentive. In my view, it should be done over time as the higher compulsory contributions are phased in and have a greater impact. There are a couple of other so-called incentives, transition to retirement commencing at age 55, splitting, etc. These don't exist in most other countries. They are costly for what they achieve, and they're incentives that are no longer appropriate given the maturing nature of the Australian system and the high level of compulsory contribution. And the other comment I'd make is that I think some in the industry say no change, we need certainty. That's a touch naive, because no government, doesn't matter who's in government, is going to leave untouched major areas of expenditure such as, in this case, retirement incomes and superannuation, or indeed health or education. There's going to be a regular policy adjustment depending on government's fiscal circumstance. Well, in terms of SMSFs, you can become your own trustee and effectively then make a decision to administer and carry out personal investment by moving out of a prudentially regulated fund, not just industry fund but corporate, retail, etc., into an SMSF. Now the evidence is clear. If you've got a low balance account, i.e. less than $200,000, it's a very costly exercise in terms of fees and charges. And it's partly driven by accountants advising members to do this, some planners but predominantly accountants. It's driven by a desire, to some extent disillusionment with negative returns and large financial institutions, and the belief, I think not correct, but the belief by individuals they believe they can do better and take control of their own destiny. So the response of the prudentially regulated funds, some of them are incorporating an interactive member direct platform within the fund. So Joe Smith can personally trade in real time in individual equities, bonds or cash, as you can in a separate self-managed super fund. So it's adoption of new technologies. There's widespread interest amongst all the prudential funds, not just industry but public sector, corporate and retail, in doing this, and some have done it. But secondly, it needs to be accompanied by an effective communication campaign. The funds have not done a good job communicating to their members the cost effectiveness of being in a prudentially regulated fund. And the other critical issue is, if you go to an SMSF and your money is stolen, there's no compensation in the event of theft and fraud. Whereas if you're in the prudentially regulated environment, you are compensated in the event of theft and fraud. And for an account with less than $200,000 or $300,000, being in a prudentially regulated fund is much more cost effective, lower fees, which ultimately reflects in a higher retirement income.